Hello, fellow real estate enthusiasts. I'm Richard Montano, your host of The Loudest Silent Partner, the ultimate podcast for savvy investors who want to diversify their portfolio with passive investment opportunities. Join me as we unravel the secrets of successful real estate investing, where knowledge meets profit. Whether you're a seasoned pro or just starting, we've got insights, news, and inspiring stories you need. Let's turn the page on your real estate investment journey together. This is The Loudest Silent Partner, where your investments speak volumes. All right, Gabe. Welcome to the show. Thank you so much for coming. It's been a while of us trying to set this up.
Yes, it has.
We have our phone calls, but we haven't done this yet, the formal meeting on the podcast. So thank you for coming.
Me.
Awesome.
Appreciate it.
Yeah. So I would love for you to share more about yourself and how you got into real estate and what you're doing today. Our listeners are people who are interested in being silent partners, investing in syndicators and looking at different options for real estate investments. And so you and I have talked quite a bit about it. We have lots of things we could talk about, but today we can talk about what you're kind of working on today. So please help us understand where you came from and what you're doing.
Sure. Yeah. Thanks again. Really appreciate being on. So my clients tend to want to be silent partners, really. And I decided to become a specialist in a very niche and narrow band of real estate, 1031 exchanges into DSTs, also known as Delaware Statutory Trusts. Terrible name, but it's a great solution for a lot of people. And so before we get into that, I'll kind of give you some background of kind of how I got to where I am now, what I saw in the market, and why I decided to jump in head first. So going back many moons ago, even before I was born, my grandfather came to this country in the 70s and essentially came from a place where you weren't allowed to own private property. In fact, he had his home taken away from him, believe it or not, for the greater good, of course. And so when he came to this country, he pulled up family money and did the next best thing, which was owning private property, which was really important to him. He didn't take it for granted. So grew up in a real estate family. It's been dinner table talk since I was a very little boy, and basically everyone in my family has been in real estate in one way or another: development, construction, sales, management, you name it.
That's one of the things that you and I have so much in common, because my dad used to say there's no more real investment than real estate.
Yes.
And real estate was such a common conversation at the dinner table that it was almost weird when I got older and people had no idea. They didn't understand, concepts of just owning real estate or why it's important and, how it affects legacy and long-term, benefits of it. And so you and I connect on this very much so. And I do this today with my kids. I know you're going to be doing it with your kids, even if they are like tiny. They may not understand everything, but I know you're going to do it. But anyway, so
my oldest daughter, I'm so proud of her because I just started talking, she's 5 years old, and I just started talking about the concept of saving. And she's now goes around saying, because they're saying, oh, do you have any money? You got to pay for the chips or something like that. She said, no, I'm saving my money.
Yeah.
And so I really enjoy that. And
I love that.
It makes me proud. But on that side note, essentially, I agree. A lot of people we speak to, it seems like they didn't grow up talking about money or investing or anything along those lines. Maybe it was a crass subject and it's just not something you talk about. But I grew up in that family, and it just doesn't seem like I'm better prepared for it. It's not something that should be hidden. It should be something you talk about and try to, become good at, essentially. It's something that can solve a lot of people's problems, of course. So, going back into my background, you fast forward, up to about 15 years ago, and I jumped into, I wanted to be in real estate. So I jumped into property management, managed over 100 doors, did a lot of business development for the company, and just basically understood A to Z how to operate an investment property, a lot of apartment buildings and rental properties.
And that's an interesting place to be in too, because you're dealing with tenant and landlord.
Yep.
So you're getting both perspectives. Yep. Which I know for a fact that's invaluable to who you are today and what you've been doing.
They both want something, and I'm in the middle.
Yep.
So I got to figure out how to make everybody happy. And it's a good push and pull scenario of trying to figure out how do I make everybody happy, because everybody has their needs and wants, and they have to be fulfilled, especially from the landlord investment side as well as the tenant side. They have a lot of interest, and that's where they live, et cetera. Right. So everything from accounting to management, maintenance, construction coordination, you name it, leases. I was involved in that throughout that process. And then, of course, I started to be intrigued by the owners who would buy and sell real estate. And I just decided at one point, I said, I'm going to get into sales and brokerage of investment real estate. And so my market where I lived and operated one was coastal San Diego. And so Pacific Beach, La Jolla, Ocean Beach, Point Loma.
Not bad places to be in.
Not bad places to be. It was a lot of fun, and I really enjoyed that market. However, not an easy market to be in brokerage. Number one reason not to be in coastal multifamily is because no one ever sells their beach apartments. If you have beach apartments, the demand from the tenant side is incredible. The rents keep going up, even if you don't do anything to your apartments. The value keeps going up consistently over time, and that's been proven. And I'm still a big believer. I think you can't go wrong with that. If you're willing to hold on to those assets for quite some time, it's going to be a home run for a lot of people. So, that being said, that was a hard part for the brokerage side because, my fee was earned by sales. And so I would talk to a lot of owners and I'd say, gosh, you bought this property 30, 40 years ago, and now it's worth 10, 20 times sometimes of what they paid for it. Even from the year before, it's probably gone up 10%. And you say, why are you still holding on to this property? Everything you've told me, you've got some maintenance issues, you've got some big capital expenditures, you probably have to do a new roof, new foundation, that kind of stuff. And then you got issues with, your rents are 20 or 30% below market. What's going on? Like, you're not really telling me the story here. And they say, you know what? And of course, I'm the young guy telling them what to do, right? Their net worth was 100 times mine, right, at the time. And they'd say, look, kid, I have no issues right now. You're right, I have bought it low and I've made 10x what it is, and I've gotten all my money back. And the reality is I want my life to be easy. And so keeping those rents below market means you weren't getting calls all the time. The tenants were happy, they were below market. Keeping those problems at bay was something that most of my owners wanted to really hold on to. And so essentially most of the conversations boil down to two problems. That's, essentially, I don't want to pay taxes if I were to sell. And then where do I reinvest? Because this is an investment and I'm not going to just cash out and buy a yacht or, a bunch of 5 secondary homes or anything like that. Right. These are responsible people at the end of the day, and they're not going to you can give them $1 million. They wouldn't spend it overnight. Yeah. So they have to reinvest. Right. And so my very first transaction was a 14-unit apartment building in Pacific Beach, and the seller actually did a 1031 exchange.
That was your very first transaction?
Very first transaction.
That's incredible. I mean, that's a good transaction.
Yeah, $2.2 million. That was my first sale.
Wow. Which in today's dollars would be a lot more, right?
Oh, it was 14 units in Pacific Beach for $150 a door. I mean, it was, we'd all jump hand over fist to get that deal right now.
Yep.
But back then it was 2011 or so. So, I mean, it was just a tough market still.
Did you rep the buyer or the seller?
The seller.
The
seller. And the seller did a 1031 exchange into self-storage out of state. So that was my first transaction, was looking at this tax deferred exchange and learning about how this investment was still an investment for somebody. And they were making calculated decisions as to what they had and what they were going into.
That's right.
And it wasn't just a flippant, I'm going to just sell my property, right? It was all a decision. It was all a plan that had to be executed. And so that's where I started to learn more. I did brokerage for about 10 years, and I did a lot of creative deal making because I had to solve these people's problems. It wasn't a lot of problems. They had, they were in a good position. I mean, and my job was to better their position, which means I had to get from, if this is the spectrum, I had to take them from where they were to just a little bit higher.
Right.
I mean, it was not much more to go. They have a fantastic position they were in. So I had to really focus in on doing creative deal making. I did everything from 1031 exchanges. That was the biggest tool in our toolbox, to installment sales. We also did master leases. Yep. We did all types of transactions.
Yeah. At some point, we're definitely have to dive into that because I love those creative methods of transacting.
Yeah.
So we'll definitely have to talk about that too.
Yeah. Once you figure out how to execute some of these options, it's an amazing presentation and proposal to somebody.
Yeah, just another tool in the toolbox.
Totally.
Right? Totally. You have a problem. Here are the best tools for that problem. Let's lay it out. You pick one.
Right.
Yeah.
And so to kind of get to the point here of where I am and how I got here is that a lot of my clients would say to themselves, I have all this appreciation and I don't want to pay taxes. And where do I reinvest? The reinvestment part is actually the hardest part. The tax code is very clear on how to defer those taxes, but you have to reinvest that money. And so I would look at someone who's, probably in their 60s, 70s, 80s. And as a kid, I would say, hey, why don't we sell your 8-unit apartment building, go buy 16 units, further inland. You'll get a better cap rate. And they'll say, once again, kid, I don't want to go manage 16 units, right?
Right.
I'm barely managing these 8 units. And so I started to listen over time, and they would say, I want to remove myself from management.
Yep.
I want more cash flow. I want principal preservation. Okay. I want to make sure I don't lose my money. You know, my favorite line is the Jim Rogers line, which is, you know, I'd love a return on my money, but more importantly, a return on my money.
Yeah.
So
exactly.
It's important to look at that and say, what are those issues for clients, and how do you solve those? And so about 5-6 years ago, I started to learn about DSTs, and I started going to some luncheons, and I started to learn from different sponsors. These are syndicators of institutional real estate, and they would put these deals together, and they call them DSTs. DSTs are recognized by the IRS, revenue ruling 2004-86, just in case you want to look it up.
Probably
not. And so the reason why I mention that is because it's black and white.
Yeah.
In the tax deferral world, there's some gray areas. You know, depending on who you talk to, they're going to say, well, if you do this, you have to pay taxes.
Right.
Well, let's be clear about that. You know, is that a interpretation, or is that black and white? And I stay in the black and white because, you know, I plan on being here for a while.
Exactly.
So when these people come back to me when they get audited, I'm going to say, yep, this is the IRS code we used. This is the revenue ruling we used.
Yep.
And of course, make sure that you always talk to your attorney as well as your tax advisor when it comes to any of these issues. And so, you know, once again, I'm not a doctor. I just play one on TV.
That's right. Yeah. Well, I mean, I think it's, you know, it's interesting because, you know, I've had so much of your story, and we've talked about this before. So much of your story is parallel to mine. Like, we've done like the same thing, same realizations, property management, all those things. Getting to that point of understanding, how do we help an investor go to another property, not pay taxes, and in essence, eventually get to a point where their beneficiaries won't pay taxes.
Right.
Right. So just keep growing and growing until that day comes, and then, you know, you move on and that the kids take over the property. So, but there's options, right? You could do a 1031 exchange as a tax deferred exchange. You could exchange it into another property. Like you mentioned, you could do a TIC, a tenant in common, which were really popular in the early 2000s. I mean, they were, and even late 90s, they were going crazy. And then the bubble popped and a lot of people got hurt in those TICs. And then also that later part of that boom, we saw DSTs coming out. When did DSTs start? It was like what, 2004, right? And then, and so from there, a lot of people had more options. So we've got all these options, but like what are the benefits of a DST over a traditional 1031 exchange or a TIC?
Sure. DSTs actually started in the 80s. It's a business trust out of Delaware. But it wasn't until 2004 the IRS recognized it in the revenue ruling. And so that's when they recognized it as a 1031 exchange eligible asset. And the reason why it's important that it's eligible, it's one of the very few syndicated investments that you can 1031 exchange into. There's lots of other syndicates. There's general partnerships. There are REITs, REITs.
Yep.
There are all types of them that can be, you know, funds that are out there. You can't exchange into those. Okay, you have to use cash after tax money to pay to get into those. So the exchange portion is a big deal. And so when that came out, that was a big deal. Now, going back to a typical 1031 exchange, which is, you know, selling one property that you own directly and buying another property that you would own directly, and you would manage it or anything along those lines, hire a property manager, et cetera. But you'll be in charge of all decisions. Right. You're the legal owner, et cetera. Great option. I mean, quite honestly, most people I talk to, half of them DSTs are a good fit for, because they might be still very active in their investment cycle. They need to buy something local. They want to manage it. They want to take care of it. So all those things, if you want to roll up your sleeves and get into real estate, I'm 100% encouraging of it. I do that myself. I have a certain clientele that's of a certain demographic that's really trying to achieve certain goals. And that's where I'll say, this is where you might be a good fit for you. This is where it may not be a good fit for you. Now, moving on to TICs. Now, TICs were popular, tenant in commons. And so a tenant in common is a way of holding real estate where each of us can have a portion of an ownership of real estate. So it's a fractional ownership. The problem with tenant in commons was the structure. At the end of the day, it's limited to only a certain amount of people. I forgot, it's about 35 people or so. I think the maximum number of investors you can have in a TIC. And the problem ended up being is that every single investor has a say in major decisions. Right. And so
including like financing.
All
like
major decisions.
All major decisions, having to sign off on financing, any sort of major changes on title, you need sort of a group
That's right.
agreement.
Right.
Yeah.
So financing, major capital expenditures. If you want to sell the property, you have to make all those decisions together as a group. And I've heard a lot of horror stories where there's one holdout.
Yep.
And that's where it gets scary, where, who are the other investors I'm investing with? Do I know them? Do I know them well? Are they going to make the same decisions I'm going to make?
Right.
And that's where a lot of issues were on the ticks. In addition, I've always asked people who had ticks that didn't go well, what was it you invested in? Because they would just blame the tick. I said, the tick's just an entity.
Yeah.
The tick doesn't really mean anything. What was the deal? And they'd say, it was a highly leveraged strip mall in Las Vegas.
There you go. There you go. That's it right there.
I'd say, there are fundamentals to looking at investment real estate. And this is why I jumped into what I'm doing now, is because this area of my business is underserved. I mean, essentially, there's a lot of people who have perhaps good intentions in my business, but they don't have real estate investment knowledge.
Yep.
It might be an option in the menu of offerings that they have alongside of retirement accounts and stocks and bonds. And they're usually just used to, looking at companies and saying, how strong is this company?
Yeah.
I'm looking at how strong is this real estate deal?
Right.
Because there's a lot of things to look at. That's pretty fundamental for me, is looking at the real estate deal. What's the financing look like? What's the demand in that area look like? Did they buy it right? There's simple questions to ask.
Yeah.
Looking into it.
There's also another, there's a conflict of interest sometimes too, you have to consider, because sometimes brokers who are putting deals together, they just want the transaction to happen.
Right.
And so these ticks, they're like, putting these ticks together, and, on the cover, it looks good, but the broker was the one leading the charge. The broker may even be the syndicator, and then it gets together, it happens, and it's like a bad deal later. And you realize, this guy just wanted the transaction to happen. So that's why he forced it.
Right.
Yeah. So
to separate the DSTs from the ticks, it's a 2.0, certainly. But what makes it so much better is that you have a number of investors, and you can have a lot more investors, so you can do bigger deals. But the sponsor ends up being just the trustee. They're not looking at the investors to make decisions. They're the trustee. They're the trustee that makes the decisions. And these sponsors are big real estate companies.
Right.
They can own hundreds of millions, if not billions of dollars worth of real estate. Okay. And they might have been doing this for 20, 30, 40 years. So this is not their first rodeo by any means. And they have a track record to uphold. Okay. And they want to keep doing more and more business. And so their job is to make good decisions on the financing, on the capital expenditures, on the asset management, and then the final disposition of the property and selling the property. And then they want to get a good return for everybody. And guess what? They want to do another DST with them, right? I mean, it makes total sense.
They want to keep those clients.
Exactly.
Yeah.
And
the other piece of that too is they have all the resources.
Yes.
They have great financing options. They have great contractors. They have, different team members that can do a lot of those things that, quite frankly, a lot of smaller investors don't have. They have to go find them after they get the deal. So
if you have $1 million and you're looking to do its exchange, and you're saying, I'm going to sell my $1 million property and I'm going to go find another $1.5 million, maybe $2 million property if I can get the right financing, you're still in kind of a retail financing situation, right? Yep. You have to go to a commercial bank or a financing broker, et cetera, and you're looking at rates that are at retail. Like you were mentioning, these companies, if you're buying 20 to 100 plus $1 million properties, now you're talking to insurance companies, you're talking to pension accounts, you're talking to the best source of financing out there. And those companies would much rather do a $50 million loan and they'll give you the best rate because they don't have to go do, 50, 100, $50 million loans, right? And so it's just a matter of scale. And so they get the best rates. And so all that takes into account, and it really gives them more cash flow, best rates, best management rates, et cetera. All of a sudden you're looking at better cash flow. And so that checks one of the boxes for a lot of my clients, more cash flow. If you're leaving Southern California, I'm probably doubling it, going out to other DSTs. Principal preservation, that's the part where I'll look at DSTs. We're not talking about just doing one. The whole point of this is to mitigate risk and do a bunch of them and diversify over different asset classes.
Is there a limit to that? So if I were exchanging, say, $5 million, can I do 5 different DSTs, or is there a limit on how many DSTs I can do?
The only limit is the minimum investment, which is typically $100,000.
Okay.
And so in that crazy case, it'd be 50
Oh, that'd be nuts.
50 different DSTs, which we have about 75 offerings right now. But between my partner and I, my partner is the brains in the back office. He's the one that looks over 200-page PPMs every single day.
Oh my gosh.
So we're together we're a team where we're looking at all these deals and kind of dividing and conquering. We have a team of about 6 of us at this point, and we just hired another one last week. And so we're growing, and it's important for us to look at these offerings, and they're coming out 2 or 3 per week. And it's important. They come and go, right? I mean, if it's a good offering, it's gone within a month. If it's a big offering, it might take 3, 4, 5, 6 months sometimes to go through. And so we need to be able to be on our feet, looking at these deals. My partner and I are traveling around the country, whether it be Illinois, Texas, Florida, visiting these properties. And so we're not just looking at the pictures online.
Got it.
So that's really important for us to do all that. But yeah, looking at all those different offerings, you can put together out of the 75 we have offered, maybe we like 10 to 15 of them at any given time. And so that's what we're working with. And so most likely you're looking at about 5, 10 DSTs for a big exchange.
Okay.
But some as low as 2 to 3 sometimes.
And how long do these typically last?
Every one of them has a business plan, right? And their business plan is to grow the net operating income over time, make the property more valuable, and then sell it for a higher price, get some equity growth back to the investors, as well as the cash flow along the way. On average, 4 to 7 years. There is a legal limit to these DSTs. It's usually a 10-year period, but rarely do they get to that point. So 4 to 7 is where most of them are landing on the disposition.
Now, from just so the investor understands this, from the sponsor side of it, what sort of restrictions do they have? Are they able to refinance? Are they able to do more work or do another raise? What does a cash call look like? What are those situations like?
Great question. And this actually goes back to the 2.0 over TICs, right? The TICs, you'd have the ability to do all those things, and that flexibility might seem like an asset sometimes, but that just creates a business plan where you have more options and you actually might be relying on certain scenarios. And so in real estate, you might be relying on a refinance in a 2-year period. You say, hey, we're going to buy it all cash, and then we're going to fix it all up, and then we got to get everyone's money back, right? We're going to refinance. Well, as what happened recently, we might have some issues with refinancing, right? And so all of a sudden, everyone gets really concerned with that. DSTs have what's called the 7 deadly sins of DSTs. And so it's a pretty conservative investment entity because of its restrictions, really. Some of those restrictions are you cannot refinance during the hold period, okay? And so that might seem like a bad thing. Well, so what that means is they'll have 8 to 10 year financing fixed for the DST. If they plan to get out in years 4 to 6, they'll make sure that the financing is going to be at least 8 to 10 years long.
Yep, that makes sense.
Because they have to get out by then. And so DSTs haven't had any issues with these financing issues because they're not being surprised by new rates. Interest rates can go through the roof. They have fixed financing.
Yep. Okay. And the lender knows that too. So the lender going into that with a sponsor says, oh, we've got this loan. The sponsor says, well, better terms on a 4 year. So I'll take that. And they go, well,
exactly.
They're like, no, hold on a second.
Yep.
You might be in a situation in 4 years where you can't sell. So this isn't good for you. Right. So even lenders, because of those strict rules, they can say, no, we're not going to allow you to do a 4-year loan.
Right. And then, they'd love to do a long loan as well. And so the loan is an important part of it. The other deadly sins are you can't do major capital expenditures. Okay. So what that means is it kind of takes the value add properties out of the picture. Okay. So you're not going to see any development deals. You're not going to see any major value add construction projects.
So the question about that. So as far as timing, because, I'm in value add. So if I buy a property and I say the value add proposition is we're going to add, $1 million, we're going to pay $1 million to add this, $2 million value, let's say. And I try to bring investors in at that point. You're saying that we can't do that.
No.
So we have to bring them in after we do the work. We put the $1 million in. Now it's like stabilized. It's a great asset, ready to rock and roll. We refinance, get a new debt in place. Then we could do a DST.
Correct.
I'm oversimplifying this, I know, but I'm just...
Yeah, and it boils down to just the DST is meant for stabilized assets, okay? Because the investors who are going into it want to have a stabilized asset that's just kicking out cash flow. Like I said, we're trying to grow that NOI, that net operating income over time. If it's a multifamily property, you're looking at inflation helping that out very easily. If it's a high demand location, you're looking at inflation helping that as well. And so that's certainly what the goal is. It's kind of the swan investment, the sleep well at night investment, right? You just kind of want to watch, it's timing in the market, not timing the market. And so this is where you're just buying these assets. And this is where I came from. I saw these owners, and these are really nice people. They're firefighters, principals, teachers, all types of different professions, where people just said, you know what, I've got the money. I'm going to buy this 4-unit apartment building. Yeah. Right. And they just held on to it. These aren't Wall Street hedge fund firms type people or anything like that. They're just understood the reality of buying real estate, just like my grandfather back in the day, didn't even speak the language. He just understood that owning private property is a valuable asset. And so it's the same idea, is that if you believe in real estate and you really to your core believe in real estate, then you just need to be in the market. Okay. And if you're checking off these boxes for these folks and saying, hey, we can get you out of management, we can bring you more cash flow, and we can diversify and mitigate your risk. How does that sound? And I was like, okay, well, for me, that sounds fantastic. And I think you mentioned this earlier about this 1031 exchange process. It's an estate plan. It's probably starts with your estate planning attorney. If you have a trust, which you should have a trust.
Please, everybody
please have a trust. I've been on the other side of not having a trust and dealing with heirs that are in probate, and it's a very painful process and
slow.
And I can only imagine that the parents didn't want that to happen. Right. So beyond that, the estate plan is to defer those taxes, and then when you pass, your heirs get a stepped up basis, which means they don't pay taxes. And so the crass term is swap till you drop.
Yeah, right.
Or defer, die. So those are the ones that but it is an estate plan, right? And so you're doing all of this to try to figure out, how do I get what I want in my lifetime as an investor who has this highly appreciated asset, while still giving my heirs what they deserve. And the idea is not take a loss in the form of taxes. Yeah, I don't care how you look at it. Paying your taxes means it's a loss when you don't have to. If it was an option you didn't have to, then why would you take it? Yeah,
we had a situation recently where we actually ended up buying a property. It was a small property. It was a triplex. The owner decided she didn't want to deal with it anymore, and she basically transferred ownership to her daughter. And then 6 months later, her daughter sold it to me. Now the cost. The basis on the property was I want to say $50,000 because she'd owned it for so long. Right. And then she gave it to her daughter at a time where it was worth close to $1 million. Right. And then her daughter immediately sold it to me for about the same amount. And I just went, oh God, I'm so sorry. This is going to suck. They're going to pay so much in taxes, whereas they should just left it in her name. Right. And then exchanged over and did something different with it.
I've heard that story a number of times, and it comes from a good place where they're saying, you know what, I want this property to be in your name, and therefore let's get it done now. Before I pass, just in case you can't get it done after I pass. Yeah, but that's where a trust comes in. I mean, the trust gets that done.
That's exactly right.
After you pass. Yeah, and so, and recently with Prop 19, they just changed the rules on how your heirs do get a stepped up in property taxes, which wasn't the case before. Right. And so, you're already going to have that. So why take on the capital gain tax as well?
I spoke with the broker about it because he was confused. He didn't understand a trust and things like that. And so I said, next time you encounter this with a client, just have them create a trust on in the transaction, in the time. Right. Do the trust and then make that person the beneficiary and the trustee. The sole trustee, right?
Prices have gone up. I think it's about $3,000 to $5,000 for a trust. Yeah. And you can get them whipped up pretty easily, and you just got to put that property in a trust. Crazy story. I was working with a gentleman in a transaction who had owned this property for, I want to say at least 30 years. 25 years ago, I think it was late 90s, he created his trust. I saw his trust, Smith Family Trust, dated 1998, right? And he's doing a transaction in 2021. And the whole time he's saying, oh yeah, the property's in my trust. The property's in my trust. I'm looking at the title report. It's in his name.
It's in his name.
He never transferred it formally into his trust. And so fortunately we got it done in the transaction and put it in there. But he was at risk. Could you imagine being in that whole time period thinking, oh, it's in the trust.
Right.
you got to put your assets in the trust.
Yeah. And even with the
That's how it
pour over
works.
will, it doesn't guarantee that that's going to
Oh,
be
yeah.
transferred into the trust.
Right.
Anyone can challenge that and go to probate.
Right.
Yeah. Tough situation. Well, this has been really enlightening on, Delaware Statutory Trusts. I think it's such a great option for people when they're looking at saving and deferring taxes after a sale. How do people get in touch with you? How do they find
Sure.
you?
Yeah, Gabe Candia. I'm a DST 1031 exchange advisor. My phone number is 619-243-9892.
Woo.
My email is
Brave man.
gcandia@emersonequity.com. Emerson Equity is our broker dealer. That's one that
Okay.
we have over 36 sponsors on our platform, over 75 different offerings, over 721 exchanges, which we didn't get into, but we can get into next time. But the bottom line is these are assets that you can exchange into, mitigate the risk. You can have different assets from multifamily, senior housing, self-storage, industrial, mobile home parks, you name it, student housing, really be able and look at all different areas of the country, from tax-free states to different areas that you might want to be invested in. So all of those just present options. And so I just tell people, if you're considering a 1031 exchange, or certainly if you're in one, just reach out, because you'll want to know your options.
Exactly right.
If you're out there, my favorite line is the fact that, if you want ice cream, you want to go to Baskin Robbins, right? They have 31 flavors.
That's right.
So you want to know all those options. You don't want to look at just different types of vanilla.
Yeah.
So it's important to know all your options and just be educated. 90% of what I do is education. So
yeah. Awesome. Well, we'll definitely have you back and talk about some other stuff as well. Thanks a lot.